Sarah and I are going to be jumping in and out of this conversation that we're having about the economy and the market right now. We figured we'll do it in a conversation style so that you guys have a little more in-depth analysis based on our research and based on what we predict is going to be happening. And then we'll give you a little bit of bullet points in each angle so that you can also use that towards social media, towards the content that you end up creating, as well as with customers. This is important to understand that your clients are looking at you for additional information. So knowing what's happening on the market or knowing what's happening on a ground level with the interest rates is something that's going to help you hold those conversations strong. So Sarah, I'll leave it to you. Let's get started.
Okay, so it's exactly, oh, it's already 3:01, so we're going to start. So good afternoon, everyone. So it is a pleasure to be here with you today to discuss the important topics that has impacted millions of Canadians. So it is the economy and the mortgage market. Just please know that along this slides or along this presentation, we might be repeating a lot of terms, a lot of terminologies, and you might notice or you might think that we are overlapping topics, but we're not. Okay, these topics, economy, mortgage markets, the rate hikes, the rate cuts, are just deeply intertwined with each other and have a profound influence with the financial aspect or the financial landscape of the country. So let's start. Next slide, please, Rosie. Okay, so these are the topics that we're going to discuss today. So, the impact of rising rates on the housing market, money supply in Canada, higher living costs, higher shelter costs, the local demand and supply, the mortgage cuts. How does the mortgage rate affect affordability? And lastly, which is the very important thing that why we're here, is how to educate your clients. So we're going to explore these dynamics and what they mean for home buyers, for your clients, for agents, and um, for the underwriters as well. So let's get started with the next slide, Rosie. Okay, the impact of rising rates on the housing market 2022 to 2023. So I just wanted to share that just like everyone around the world, um, Cree Canada has also experienced a cycle of the growth and the downfall or construction on the housing market. So there are a lot of factors that has affected this. We have the employment rates, we have the inflation that we all experience, the interest rates that are insanely high and fluctuating this past few years. So all of this play a very significant role in determining the affordability and access to mortgages of our clients and of course the housing markets. So the health of the housing market is not just for the homeowners or for the home buyers. It is for the wider economy. So it's not just mortgage. It affects us, it affects everything in the economy. So this recent year, sorry, this 2022 to 2023, the Bank of, we're just going to discuss the impact of rising rates. We're going to discuss few. So interest rate increases, effect on home prices, the buyer behavior, and the sellers. How does it affect the sellers? So interest rate increases. So 2022 to 2023, these are the years where we have seen insane interest rates. Actually, we're still feeling it up to this point, but we are noticing or we experience a little decrease in the interest rates slowly. So the Bank of Canada raised the interest rates during these years to control the inflation or to combat the inflation. However, this has led to a higher mortgage cost, and as mortgage rates increases, we all know that the cost of borrowing also increases, making it very expensive for for the home buyers, or less affordable for many Canadians. So we have seen, all of us, even Ali and the underwriting team has experienced a slowdown in the home sales. And then we found it hard to qualify our clients before the increase on these interest rates. Some of the clients we have spoken to qualify for 1 million, but after the increase, they can only qualify for barely 700,000, 800,000. So we've seen a struggle in affordability. Okay, so because it, higher interest rates means higher mortgage payments, and it reduced the affordability at the client, and it has cooled off the market activity. Um,
So,
and
Sarah, sorry, I just want to button very quickly. So, just to kind of go back into the historical. So, COVID happened, everything
yeah,
got shut down, logistics were affected, um, and to forcibly trigger the money supply so people could actually survive, CERB came into effect. CERB was basically a government funding paid out to millions of Canadians. So that did not automatically have that did not have a qualification criteria, and everyone had $2,000 in addition. A lot of people, not everyone took it, but the people that did was a significant population. So a significant amount of money supply in the market meant that they're going to keep the country moving in the right direction. So people have money to buy food and groceries and so on. And as the amount of money continued to grow in circulation, it increased the pricing. So we're basically just talking inflation now.
yeah,
Now, a year and a half later, there's too much of inflation and there's too much of money supply. So the only mechanism that Bank of Canada has is to be able to kind of reel back all that money that they put into the economy and try and reduce the pricing. But that is a very challenging angle. And that's one of the reasons why we've experienced over the last 18 months, there was a higher interest rate cost. And um, hike after hike after hike, I know people have suffered, people have cried, people have lost their homes. And it is the worst possible thing that you can experience, especially as a mortgage broker, because you're talking about a variable product and all of a sudden the variable is shot up by almost 300 basis points. So that in itself plays a very negative role. But that being said, reeling back to the cuts, now what is happening is that the prices have stabilized. And keep in mind, when we look at a stability angle or a pricing angle, we're actually looking at it in perspective of a couple of years before. But unfortunately, COVID was a unique incident. That's why we have to go back into 2020, 2021 to be able to understand that as well. So specifically in terms of the pricing, we're actually seeing that it's coming down consistently, and the buyer behavior is also changing and adapting to that. I'll give you a very quick example. Literally about 2.5 months ago, our best rate was about 5.49%. Right now, today's rate, we're sitting at about a 4.24% for an insured mortgage. So that percentage and a quarter of a discounting applicable in insured mortgages, like Sarah said, has the ability to give buyers a little more control to be able to purchase for a little more. Sellers that are selling in the market, there are two kinds of sellers in the market right now. One, that are actually struggling with the payments that want out, or two, the ones that are legitimately looking to upgrade in the season. A large proportion of those are the people that are struggling with the costs and they want out, which is why the pressure is on the sellers to be a buyer's market right now. And this is one of the reasons why when your marketing is geared, it should be geared towards, hey, take advantage of the marketing, take advantage of the buyer's market before the interest rates come down so low that everyone jumps into the opportunity ship so they can start grabbing those properties again. When the Bank of Canada rates go down, so does everything else. You're actually going to start seeing the privates come down too. There's still a little bit of tightness in private money supply right now, which is why it's still hovering about 9 to 11 to 13%. But depending on what BOC ends up being in about 6 months out, you're going to start seeing a discount there. A couple of the lenders, like Brook Street, has actually gone down to about 5.99%, which was, again, a pre-COVID interest rate. But now we know what we're looking at, and rates are still starting to come down. Sarah?
yeah, yeah, that's right, Ali. So we're gonna discuss a little more of that later on. The rate cuts that we are all anticipating and analysts are expecting, but this one we're gonna this is the effect. We have to go back a little bit on the previous year so that we'll understand and appreciate the future rate cuts that we're gonna have in this last quarter of the year and to 2025. So
Beautiful.
as per Ali said, like this market is geared towards the buyer. So it is a buyer's market. It benefits the buyers. The sellers right now, it meant a very challenging. It is a more challenging market for them as the higher market rates reduce the buyers' affordability. So it means that it sellers are facing longer listing periods and price reductions to attract the buyers. They're adjusting their pricing strategies to attract buyers in a cooler and less competitive environment. So we're seeing a domino effect of rising rates on the housing markets, and we can see it as severely on a several interconnected areas, like Ali discussed. The rate increase effect on the home prices, the buyers behavior has changed as well. The market, the previously hot market, 2019, 2020, during this year's, it has cooled off, and then the seller has faced,
Significantly, yeah.
yeah, significantly, and then the seller has faced a challenging market for this year. So Ali has already mentioned the money supply in Canada, which is to control the interest rates, to control the inflation and the money supply. So next slide, please, Rosie. We're going to discuss that.
So just to speak on money supply, we are very connected to the construction loans. Like we do a few construction loans every now and then, and the construction loans are primarily an indicator of how much housing development is happening. And we get our feedback from lenders that are willing and able to supply the money. And the way monoline lenders operate, or the way private lenders operate, they may have their own book of business of, let's say, 20, 30, 50, 100, $200 million, but they also have a line of credit with the big banks, because the big banks are also investors in these mix. And when their line of credit is reduced as an available limit, that crunch is what we also feel, and the customers also feel. And that tightness in the money supply is what we're experiencing right now. So we're not seeing a lot of development happening. We're not seeing a lot of construction happening. However, as the interest rates start to come down, we will start seeing the relinquishing of control over the money supply. Rosie, go ahead, please.
Yeah. So
Sorry,
money supply.
Sarah.
Money supply in Canada and the effect on the rate increases. So though we're seeing slowdown in interest rates right now, we just have to acknowledge what happened in the past so that we can understand the future. So the money supply is controlled by various monetary policy, Bank of Canada, and it plays a very crucial role in shaping our economy. So when, as what Ali mentioned earlier, that there is a high inflation during the COVID periods because we are all spending. There are a lot of money circulating in the market or in the country. So the Bank of Canada has to raise the interest rates to discourage consumer spending and to control the inflation. As the result of this, there is also a slowdown in the economy. So the tightening of money supplies, it has impacted the various sectors: the construction one, the real estate, the housing market, the credit market, and it has reduced significantly the affordability of our clients, and it has dampened the economic activity of the country. So with the less borrowing power of our consumer or our clients, it means that there is a fewer real estate transactions that we should all agree that we have felt it, right, Ali? We have felt that during this year's 2022 to 2023. It has reduced.
I want to focus on the silver lining, though. So I want to focus on the fact that, yes, what's done is done, but we're starting to see a change in attitude. So sorry, I'm cutting you off, but I just want to kind of drive the presentation along, and I want to share specifically what's happening. I don't know if you guys read a headline maybe almost a month ago, that CIBC was complaining about the liquidity angle of availability of funds to be able to clear checks with intraday banking. What that really means is that every day the clearinghouse confirms how much money is owed to each one of those banks. The central bank acts as CIMCOR acts as a moderator for the amount of money that's owed to each of the banks by each other. And liquidity is an issue with three out of the big five players right now. And what that means is that there's not enough money to go around in the market to accommodate immediate, regular clearing. So what you are seeing as an adverse effect is when people are depositing the checks, you're actually seeing holds of a longer duration or more stricter guidelines against the holds that are being put in place by all the banks. So Bank of Canada literally, I think immediately after the headline came out, within a week, ended up buying a lot of those bonds so they could release some of the access to the money. And that has led to a little bit of cooling in the money crunch, and it is starting to get better. And it will continue to get better because as the lower interest rates prevail, there will be additional money supply that's made available. So the purpose behind this slide is to help you guys understand that money supply is slowly getting better, but it cannot go up in a single shot, and it will gradually grow as inflation continues to go down or continues to be consistently lower. And that is when the interest rates are going to start coming down. So whether it's housing market impact, government policies, all of that, you have to speak to how the market is improving with your customers and how money tightening is actually being decreased as the interest rates are starting to come down. But that being said, there's open banking that's already come into play, and that is forcing a lot more verifications, a lot more scrutinization. You guys are probably familiar with FinTrack kicks in October. So all of that is still going to add a little more pressure to the mortgage market and what we can convert, but it's still not going to be as bad as it was over the last 18 months. Next slide, please. Rosie.
Rosie, next slide, please.
It should be like a pager.
Okay, so Ali has been discussing this since the initial of the presentation. We're going to discuss the local demand and supply in the housing market. So the prices and the demand are correlated with each other. So the higher the demand, the higher will be the interest rates with that will be applicable to the investments. But with the mortgage supplies, with higher rates, the demand for homes declined as fewer potential buyers qualified for mortgages. This is 2022 to 2023. So Ali mentioned that we have to focus on the silver lining or in the future that as we are seeing decline in the interest rates, we are also going to see a demand for future for purchasing of future homes, and there will be more potential buyers that will be qualified for mortgages as there will be adjustments in the mortgage stress as well, and there will be a lot of available incentives and government assistance with this. Supply will
So
be
you've already got, sorry, go ahead.
Yeah, go ahead, Ali. Is that about demand?
Yeah, no. So, okay. So we're already seeing the interest rates come down. So automatically with the interest rates, with the fixed rates, we're actually seeing the qualifying rate coming down too. Like literally about 2 months ago, we were qualifying an insured deal at 7%. Now it's 6.24%. And I don't know if you guys remember, it used to be 5.25, 5.45, somewhere around there. So it's starting to get better. We do expect, my prediction is we're going to be hovering anywhere between 3.2 to 4%. I know it's a 75 basis gap, but that's essentially where BSE wants to see it at. And the reason I'm indicating that is because as of right now, there is a significant demand issue, but there is oversupply. And we can talk about the oversupply because there's a lot of closings that aren't happening. I'll use Lenmax as an example, and then there's another dozen mix to follow. That's a real-time pulse on hard money lending. And we're not touching condos at anywhere close to about 75%. So we're actually saying 65, 68, maybe 70 if it's not a one-bedroom property for the investor opportunities. We're actually more focused on the 2 beds and 3 beds kind of condos. And stepping away from the condos, a lot of builder sales have fallen apart because your appraisals aren't coming back. So as of right now, there's a lot of inventory available, which means the clients that have been sitting on the borderline for the past 18 months to 2 years, and let's talk about that for a quick second. There are people that have been wanting home ownership. There are people that have been wanting to get into the housing market based on not just the need for shelter, but also one of the reasons why the Canadian housing market is as strong as it is, yes, the immigration has definitely helped, and then the trends have definitely helped. But most importantly, the rate at which we see equity growth, and I don't know if you guys were a part of the other training that we did with the U.S. market, where Henry was talking about the year-over-year increase, and I was kind of laughing on the inside at where he mentioned, well, year-over-year it can actually grow almost up to 4%, where our year-over-year growth ends anywhere between 8 to 10%, and sometimes even higher. There have been times when you book a property for $800,000 and you're walking away with $1 million in less than a year. That's about 20% of an increase in property values. So the point that I'm trying to make is that that's no longer happening, because of which supply is now readily available, and people that have been sitting on the borderline, they need a little bit of a nudge, they need a little bit of a push, because if this rate continues to go down, the only thing that's going to happen is another shit show of a market that we saw during COVID, which means it's a hostile environment for a low interest rate, and investors are going to jump in, and everyone who's been looking at the opportunity to buy is going to jump in, and we're going to have those rate wars, bidding wars all over again. So the education that needs to be put out there is the money supply is improving. Supply in the housing market is readily available to accommodate your offers, and you should be looking at pre-approval, so you at least have something in black and white, so you can 100% go for that property that you're trying to purchase. Go ahead, please.
Yes, that's right. So that now leads us to the next slide, which is the impact of future rate cuts. So everyone is excited to discuss this. Everyone is excited to hear that the rates are going down. And analysts has predicted this, that we have already seen that. We have already experiencing that. Last 2 months, I have qualified the clients at 4.84. One of the agents here in the Zoom has that approval. But right now, I am qualifying the clients at 4.54. There's also lenders are offering 4.24%, 4.34%, and inflation is stabilizing right now.
Just, just so people don't rush to the underwriting team with a 4.24, FYI, that's a 3-year rate, and it's insured. So, and it's also paying a limited comp. And
Yeah.
I don't know if I posted it in the WhatsApp group or not, but just as an FYI.
Okay, so lower interest rates means that there will be a reduce in the borrowing cost, making mortgages and loans more affordable for the consumers or for our clients, and encouraging more people to buy and people to enter the market right now. So the future rate cuts will benefit our purchasers or our pre-approval clients and our renewing clients. So it will reduce the monthly mortgage payments, and it will increase the affordability or the purchasing power and make mortgage renewals more affordable. With first time buyers, lower rates will help them qualify for larger principal mortgages, and it will lead to an uptick of demand. um,
I just want to add my 2 cents here. So I was sitting on the board of FISRA for I'd say almost a year. I just recently resigned, and the last conversation that we were having was how renewals are going to be impacted by the rates, and the qualification is still going to be impacted. And it's yet to be seen. I've been proven wrong, but my prediction, like I explained to you, is that in the next 6 months, you should actually start seeing rates closer to the high 3s or the low 4s. And the reason I'm saying that is because there's just so much of bloodbath out there, and the economy is actually really struggling as we speak, that they won't have a choice but to actually reduce it. The only reason we haven't actually gone down significantly deeper into rate cuts is because the Fed in the US hasn't accommodated the same rate cut. So we're kind of leveling off to make sure that our loonie doesn't drop any further, which it already has. And going back to the renewals and how people are going to be struggling, I don't think they're going to struggle. What that means is that we were anticipating almost 6 months to a year ago, holy crap, the rates are sitting at about 5s and 6s. We actually had like a TD uninsured was going for about 5.99 and 6.05 4 as an interest rate for a 5-year, for 25-year and 30-year AMs. But now that we're starting to see insured rates come down almost at 4.24, 4.3, 4.5, that means they're still going to come down a little more. And the best time for you as a mortgage broker to explain to your clients and audience that you have a better offer, you have a better product, is when there's a lot of uncertainty in the market. For you to be able to cut through the noise and explain to your client that, hey, I have the best offer on the table based on XYZ reasons, I think that is the primary objective for you. If you've spoken with me about renewals, then I always say capturing renewals is hard because you're always competing with the bigger banks. In most cases, you're like, let's be honest, the 65% of the market is controlled by the big five. So if you've got 100 customers, 65 of those customers belong to the bank. And chances are they've already received an early renewal or something like a moderated renewal, or maybe 30, 60, 90-day advanced renewal. And I'll share an experience right now. We had a client who we funded maybe about 3-4 years ago, and it was a variable rate. And she stuck it out. Our client stuck it out with the higher rates, and she was perfectly fine with that. And then now come renewal, 9 months. And even though it was our deal that we submitted to TD branch is actually calling that customer, offering her 4.25% to lock in for the next 5 years. And what I mean by that is that renewals are hard as it is, but because there's so much uncertainty in the market, everyone is confused about where the market rates lie, where they sit. And this is the perfect time for you to pitch out those rates and try and figure out if you can help those customers. And the renewals present an opportunity right now where you can possibly moderate and talk about a better solution, and talk about, there's something that one of my friends shared with me, and he and I are principal brokers. So it's a level of conversation where we see how our agents perform and what we as brokers have to do to be able to get business and retain business. And we've said this before, I've said this before, and I always pointed out to help agents understand what our mandate is and what we actually need to do. During COVID, when the rates were going up, the example that we use is there wasn't one single banker that was calling customers and letting them know, hey, right now is a beautiful time to lock in, or right now is a great time to actually secure your rate before the rates go up even further. However, when it comes to trying to lock in at a later date, they're always going to call you. Banks employees are always going to connect with you and try to offer an interest rate to try and lock you in so that you get tied up with that interest rate. Now is not the time to lock in. Now is the time to get into a variable rate. Because if we see the trend, if we see the historicals, then the rates are actually going to continue to go down until the economy gets better. And if you know what a boom in a cycle looks like, a boom in a trough cycle looks like, which is the higher market and the lower market business cycles, then you already know that each cycle lasts on average about 3 to 5 years. So if we've already gone through the shit show for 3 to 5 years for a higher rate environment, in our case, we didn't necessarily extend to that level, but it was triggered by COVID. But we did go up and down in a cycle, and now things are starting to normalize. We actually have another 2 to 3 years at least to be able to benefit from a variable rate. So if that comes up as a conversation, the bank's job is to try and commit them to a fixed rate. Your job is to educate your client to help them understand now is a low rate environment. It's going to go further down. Now is the time to actually get yourself into a variable rate as well. Go ahead, please. Wow, that was long-winded.
Yeah, and it has also discusses the renewal. Ali, I think you are going to have a specific webinar about renewing or refinancing the clients.
We're going to be talking about renewals and refinances. So renewals is going to talk specifically about how to hold those conversations, and refinances we're going to use the calculator to figure out if we can determine if the new payment is actually going to make sense or not. And the beautiful, beautiful part of this strategy is that a significant population is currently relying on line of credits that have touched even 7.2%. And it's a great opportunity for you to talk about how you can take away the interest payments and amortize them and make it into a one single monthly payment, and also pay down the mortgage. So we will be talking about that in the refinance conversation.
Okay, so this slide is just an addition to what Ali has mentioned, that the mortgage rates and affordability, you are going to see, we're going to see that clients could afford better housing prices, and they could afford larger principal amounts. So educating our clients if it is the right time to buy. The refinancing part is a separate one, so since Ali is very specific with that. So with the current market conditions, despite the higher rates right now, it's still on a high one. It's a 4.64%. It's still high, but we're gonna notice a softening of the interest rates and the prices of home in many regions, and it will present a lot of opportunities for buyers with stable financial situations. So 5 reasons for home ownership in this current market. So I have put here 5 reasons for home ownership, and there will be a lot of reasons, but we're just going to discuss 5 right now. So one will be the long-term investment potential. We all know that real estate is a valuable long-term investment with potential for appreciation and wealth accumulation over time. So once you have purchased your first property, and you have managed that well, there will be second, there will be third, there will be rental properties along the way, and the wealth accumulation will be presented to you.
So,
There
sorry, just one more addition to the first one, the long-term investment potential.
Mhm.
I want to summarize it by just one word: equity growth. Whether it's your own home, whether it's an investment, equity growth is very important to understand. A lot of people have been scared about the conversation around capital gain, and we will be talking about capital gain, and I'll try and do a webinar specifically on capital gain so that the scare and the fear factor can be eliminated, and you can offer an education to people as well. It's not as bad as you guys think. There is a little bit of an increase that you're seeing, but it's not enough to completely rid yourself of the rental opportunities. Now, that being said, the tenancy board is another issue altogether, so I'm not going to comment on that. But as long as someone is paying their rent and they're paying the mortgage on behalf of the landlord, it makes sense. Speaking of number 2, the tax benefit for a homeowner, the Liberal government is literally out the door almost in the next election, or at least prior to that, depends on which way it goes. But we know that there's a change coming. When you're breaking down the tax implications, we don't expect the tax implications. We were talking about this in another webinar, I think it was a podcast as well. It will not happen. It cannot happen. I think it's going to be a revolt. Canadians are actually going to stand up like they did before, but I don't think the taxable benefit applicability applies to your own home ownership when you're transferring out a home or anything like that. You will still be able to use tax-free out of your home. So on this point, I just want to remind people, and Sarah reminded me of this, when you're talking about your customers' renewals, there's a chance you may lose the renewal because the bank is offering you a slightly lower interest rate. Sorry, there's a little bit of reverb. Sarah or whoever's got the mic on, can you mute yourself? So we have seen a lot of transactions where mortgages have a deferred interest cost. What that means is when people, this is the first time ever that trigger rates were achieved. The last time the interest rates were this high was when insurance companies were running the mortgage gig. So the first time we've actually seen the trigger rates allowed for extra special case scenarios where the government said, okay, you can actually add the additional interest costs that haven't been paid out in a regular mortgage payment to the balance. And this was approved under OSFI. What that means is that even though you may have a mortgage of about $800,000, somewhere around there, there may be a situation where the bank has added another 15,000, 20,000, 11,000, $19,000 as an additional deferred interest cost, which you did not pay during that time when the variable rate went up. If that is what the case is, this is the perfect time to talk to your customer and educate them. Listen, this interest isn't going away. This is the time when you're renewing to actually convert this into a refi, build this into the mortgage so that you can pay it off. Otherwise, you're going to have to pay out a chunk. At any point in time, the bank can come back and say, hey, I want my money back. I want the interest paid out in, let's say, 30, 60, 90 days, and you're going to have to. So instead of getting into a second mortgage or the bank not being able to qualify you, the best case scenario is if you have a deferred interest as a separate component outside of the mortgage balance, try and roll it in and convert it into a refinance instead of a renewal. You'll benefit from not having to worry about it at a later date. Sarah, go ahead, please, with C.
With C, building equity over time. Ali discussed this, or Ali stressed this out, equity. So as you make mortgage payments, you build equity in your property, which can contribute to your net worth and financial stability, in which you can use later to use in purchasing another property, and so on and so on, so that you can build a long-term portfolio of your properties. Next will be security against rising rates. So we have seen we have seen a decrease in the demand in the purchasing of the property, but an increase in the demand in rental properties. So, and lastly, this is the best time. This is the market for the buyers to negotiate for better deals and purchase homes at a more favorable prices. So I just wanted to go back with tax benefits for homeowners. Ali has said that home tax benefits for principal residential is quite limited, but there are a lot of.
Yeah, no, so we're not actually. So what the Liberal government was looking at was whether if you're transferring out the property from out of your name into,
Mhm.
let's say, passing it on to someone else's name, would they be able to charge a capital gain component to that? Because they bought the property at, let's say, 15, 20 years ago at $250,000. Now the property is worth $1 million. And does that mean that 800 or $750,000 is subject to tax and capital gain? The answer is no, it's not. It's never have been. It never has been. And they were looking at that as an option to try and raise taxes, or at least try and make more on taxes. But we don't foresee that happening either. So as far as you want to share with your clients, it is a tax-free access to your funds, whether you do a HELOC, whether you do a HELOAN, whether you do a refi. So feel free to use it, and might as well use it now before anything along those lines happens at a later date.
Okay, awesome. Thank you so much for clarifying that, Ali. So I just put here a tailored advice that that this is something that we all, as mortgage agents and mortgage brokers, that we need to keep in our mind that each client's financial situation is different and unique, and we have to offer our personal advice based on their income, savings, the current market rate, the future market trend, and the future rate, and those things are essential with that. Next slide, please. Rosie, next slide. So the benefits of rate cuts for clients, qualification and affordability. I just summarizes here three, but Ali will help us in expounding this. Improved mortgage qualification, lower monthly payments, and the cost of home ownership. So first one, rate cuts will allow more clients to qualify for mortgages with larger principal amounts. We have mentioned this with the previous slides over and over again, that lower interest rates will increase clients' affordability because there will be less or lower monthly payments, and that leads to the second one, lower monthly payments. Reduced interest rates is translated to more affordable monthly payments. Thus, it enhances home ownership prospects. So we're going to see um, an increase in the increase in the deals that underwriting will be dealing through, or increase with your clients as well. And the cost of home ownership will be significantly reduced, and it will attract lots of buyers to enter the market. Anything
Okay,
to?
so if I can just add my 2 cents here. So improved mortgage qualification. Right now, the market is tight. The market is tight because banks are scared. They haven't been in this kind of a situation before, so they're conserving their portfolio. They're still lending, but they're conserving their portfolio. We used to have a few credit unions that offered us an exclusive program depending on your portfolio and what we were funding them. It was basically an exception where we were able to fund deals on a contract rate. What that means is, in some cases, again, in some cases, you would be able to get away with, let's say, 4.34% as a qualification rate, and you did not have to add the stress test. Credit unions operate on a provincial level. They did not qualify under the OSFI regulation, and on a federal level, which is why there was a loophole in the system. So they were basically operating with the intent of being able to qualify those customers. Some of those programs are expected to come back, and the reason I suggest that is because people are dying for business right now, as we are. And those opportunities will come up because what we are starting to see is the rise of another cycle. So we're coming out of a trough or a recession, and we're going into where we're still in recession. We're coming out of a high rate environment, and we're coming into a proactive, incentivized, lower rate environment where money supply is important, and banks make money off of lending. Like, that's not a secret. So for them to be able to make money on a consistent basis, they have to rely on mortgages as a monoline product, and they will do so and create exceptions and flexibilities. The lower monthly payments is also going to be coupled, if you guys are familiar with the changes that they introduced, you will have access to 35-year amortizations as well. So we're not just going to be working with 30, there will be higher amortization options available. Clearly, it's going to come at a slightly higher premium compared to what used to be a 25 and 30, but it still is a benefit where you have the ability to manage cash flow better, your GDS, TDS is going to work better, so that will be a solution that's available as well, so it will reduce payments. And then the cost of home ownership. The supply is currently on the higher side compared to what the market used to look like. Like, the crappiest properties were selling for like $1 million, and I used to just, my jaw dropped every single time. Now we're starting to see that even though the supply is there, people are picky about what they're wanting to choose because there's just a lot more available. But that is also going to change. And the problem with that is that the mandate that the government has set out for 2030, there's no way in hell, no way on earth, we're going to be able to achieve that level of construction. If you look at the problems that we're dealing with on a construction level or builder level, projects getting canceled, a lot of the properties just sitting idle, a lot of the closings not happening to begin with. Because of those, builders are exiting the market. And when they exit the market, they're looking for convenience. They're not looking for a hellhole to bury their investment in. So when they exit their market, there's going to be fewer builders, and there is fewer builders building. There is fewer approvals that are coming through for builds. And to make it worse, we're still going to see a higher number of immigrants coming into the ecosystem. When that happens, the chemical formula is pretty scary. Values will start going up. So the cost of home ownership will eventually go up, but you have about maybe, I want to say, 12 to 18 months before you can grab a nice deal. And that's what the education needs to be for all the clients. And it's not based on just hearsay or what Ali's saying or what you're reading in Financial Times. You need to look at the statistics. Your lower interest rates are going to come through in the next couple of months, or even in the next 6 months. You're going to see a considerably lower rate. And going back to prior to COVID, rates always used to be about 3.59, 3.89, 3.99 kind of an interest rate was one of the best rates that we had. So those rates will come back, and that's going to be norm. However, supply isn't going to get fixed because there's no new construction that's happening, very limited new construction that's coming in. So because of those reasons, the advantages are to talk to your clients about the benefits of rate cuts as of today. Next slide, please.
Actually, Ali, that will be the last slide for the topic, and the next slide
Sure.
will be about the conclusion of our of the presentation.
Who wants to take a grab at it? Oh, you
I
want me
just
to
got a
go?
few things. Yeah, I just got here a few things to add.
Go ahead.
Next slide, please, Rosie. So this is just a recap. So we have discussed the 2022, 2023, how it impacted affordability, the demand and supply in the Canada's housing market. We have also discussed the future rate cuts and how are you agents going to discuss this with your clients so that you can enter the market, and that it could reverse some of the effects and the benefit, and it will offer benefits for our buyers. So we have also discussed your role as a mortgage broker or mortgage agents in educating our clients. And what the next step will be prepare your clients for future rate changes by offering them personalized mortgage advice. So now we have seen and we have understand the connections between the interest rates, the supply, the demand, and affordability. And Ali has provided us a deep insights about those things. So this is a very critical moment now to guide our clients through this uncertainty. Future is still uncertain, though analysts or everyone has predicted that there will be a slowdown in these interest rates in the last quarter of this year to towards next year. And Ali has mentioned that um, the season is like 3 to 5 years, and then there will be another, and then it will go back now to the next one. So with the current interest rates and affordability strain or affordability burden or affordability issues that we're experiencing right now, it is very important to walk through our clients with the future rate changes. Canadian market is very um, flexible, ever evolving industry and Canadian housing market. So we just really have to provide a clear, informed advice to our clients so that they can make decisions confidently despite the shifting market. So we just really have to stay informed and stay adaptable. And you as mortgage agents, you just really have to be connected with your brokerage, because your brokerage is going to provide you information about the future trends and the current market situation. Anything to add, Ali?
Yeah, so a couple of points. So this is not information that's coming from me. We actually, like, we're also getting this information from economists. Like, we had a meeting recently with the BMO economist who laid down the structure behind the economics of how rates are going to be fluctuating. There's going to be a little bit of a bond yield adjustment expected to. We're not expecting any more updates to the housing pricing, but it depends on whether the bonds perform well or not. The U.S. election is also a dependency that we have to look at for our interest rates as well. So if you actually start seeing it tipping towards the Trump side, then we're going to see a little more stability in the bond markets as well. And that also translates to stability with us, and stronger yields mean consistent pricing, if not necessarily higher rates. Long story short, let's cut to the chase. All of this crap is not what you're going to be able to explain to a client in a conversation. What you can explain to your clients is, first off, understand who is your client. Right now, there are limited purchasers that are in the market. So this is a time to acquire pre-approvals for these customers so you can help them achieve stability or peace of mind, knowing that, okay, at least I have a pre-approval in black and white. I know that this is what the maximum budget looks like. Number two, the largest proportion of your customers should be refinances. And I'm saying this because it is the easiest conversion as far as a mortgage transaction is concerned. You don't have a lot of players involved. You don't have a realtor messing up your game. You don't have a lawyer messing up your game. You don't have your appraisal coming back short. It may be applicable in the refinance as well, but at least there's no huge concern whether your offer is going to be for 500 and your appraisal is going to come back for 400. So there's that caveat. You also don't have home inspections and just stuff that you can throw you off in your transaction, even though you've put in 100%. So yes, continue with the purchases, but focus on refinances and consolidations. And the reason I'm saying that is because all you need to start your conversation is a mortgage statement and a property tax bill and a load of debts. As long as you can come back with a nice rounded figure on what your new lower monthly payment is going to look like, and with the consideration that people have been dealing with a variable rate on slightly higher rates, or they locked in maybe 2-3 years ago when the rates were slightly higher, so they're sitting over 5%. In situations along those lines, you're actually going to start seeing a lower interest rate, calculate their penalty, figure out whether that actually makes sense to them, and then bundle it up so you can sell it that way. The important thing to remember is that your guidance is what's helping the client reduce their costs on a monthly basis. So if you have the ability to specifically identify that, that's your goal. That's what people are going to be attracted to. The fact that you saved them 300, 400, 500 bucks is what they're leaning towards. One last point. The best way you can attract an audience is, I want to be clear, this is not a one transaction sort of a game. When you connect with a client, your job is to maintain that client for at least 3, 4, 5 transactions, whether it's another purchase he's doing or at least the number of renewals that he's going to end up doing with you. So when you're creating that relationship, the guidance is very important. If you were to ask most of the customers, what is their intent? What is it that they're wanting to do in the long-term goal that they have for this property? Their response is going to be, I want to pay it off and I want to be mortgage free. If you can pitch that, then you're appealing to the masses. If your marketing, if your advertising is specifically dedicated to, hey, I will show you how to pay off your mortgage in 7 or 10 years faster than what you're doing right now, what you just did for yourself is you created a client who now wants to understand wealth creation, wants to understand how to reduce his debt load, wants to understand how he can benefit by utilizing the current situation he's in or the market that he's in to his benefit and his advantage. The number of agents that we have joining in and targeting those leads, because I'm connected with NanoCode, I know how many people are doing active marketing on that. There are a significant number of leads that are being generated based on that theory, based on that formula. So they've created a funnel. They're doing marketing on Facebook and Instagram. Learn how to pay off your mortgage faster. Learn how to save money by paying down your mortgage. All those ads are leading into a funnel. The funnel leads to a webinar that these agents are doing. And every single time they end up getting 3, 4, 5 attendants or attendees, and educating them ends up being at least like a couple of conversions every week, religiously. Every Thursday, 7 or 8 p.m., they're doing it over and over and again. And it's a rinse, repeat formula where they're getting a lot of leads, a lot of actual deals, which if you haven't tried that as an angle, consider doing so, and that's also going to help you. That's the extent of what I'm going to leave you with. Otherwise, the mortgage market is getting better, and we're hoping to get a lot more business in the future. Thank you, guys. Have yourself a wonderful day. I'm going to sign out, and Sarah, I'll see you on the other side.